Good afternoon, and thank you for joining us for today's webcast, High Hopes, discussing the U.S. market on the road to recovery. My name is Kelly Curtis, and I am a marketing manager here at MicroStrategies. Joining me today, we have Anthony Bongiovanni, founder and CEO of MicroStrategies. Anthony will be your host for today's event. We also have William Foundry, Executive Vice President of Vantage Financial. Bill, why don't I go ahead and pass it over to you to introduce our special guest for today.
Thank you, Kelly. It is my pleasure to introduce our featured speaker for today's chat, Craig Johnson. Craig is a managing director and senior technical research analyst and directs Piper Sandler's technical research group. He is the past president and current board member of CMT, Chartered Market Technician Association. He has also been featured on CNBC, Market Watch, Business Insider, MSNBC, and Bloomberg, as well as many other notable media outlets. Craig, let's go ahead and kick off the conversation. Given the state of the election this week, how are you seeing the markets respond, and what does that mean for the business environment in the near term?
Bill and everybody, thank you very much for inviting me onto this webinar here today. I appreciate and feel very honored you brought me on to discuss this. Now, in terms of what I think about what's happening with the election, I think the market started to sort of neutralize itself heading into the election due to the uncertain outcomes that we could have with this election. And then post what we know so far, Bill, because the election isn't completely, totaled up yet, but, it looks like we're going to have a Democrat president, Joe Biden, and a split Congress. And historically, when we have a split in the Congress, it's typically been a positive sign for market, says we're not going to get a lot of things accomplished. And certainly with the market moving up the way it is, it suggests that perhaps some of these tax hikes that have been discussed probably get a little bit neutralized with the split Congress. And so to me, it's a good sign. I think the market is pleased with the outcome, and it's pleased with the split government and the need to ultimately to sort of build to a consensus. And that's what we're going to have to see these lawmakers finally do, is work toward a consensus. And I think the market likes that. So from my perspective, it's a positive, Bill. And I think this market could probably move higher. And as I sent out with the slide deck, this is a market that I think can continue to work its way higher. And I still look for 3,600 on the S&P 500 index by year end.
That's interesting that a split government bodes pretty well for moving forward. How does that affect the long term? Is that a positive thing in the long term beyond the next 4 years generally? What's your view on that?
Yeah, so I think as we look forward over the next 4 years or so, and we think about the split government, and then we think about some of the historical returns that we see under a split government environment. And let me just show here on the screen what I've seen in the past. In the slide deck, I just put up here, when we've seen this sort of split government in the past, we have seen that over the last 100 years, this has only happened really one other period. This is when we had Barack Obama as the president. And it was interesting is the market returns were quite positive. From inauguration year, we saw a positive 16% sort of return in the market. So again, sets up to be quite positive. And if you think about the history of elections and moving forward from there, I think as you look at from here to year end, Anthony, first and foremost, once this is all sorted out and figured out, I think you're going to see a pretty strong finish through the rest of November and December, assuming they can get this vote tabulated and finalized. But from my perspective, looking out even further than that, I gotta bring up one slide that I think really speaks to what's going to happen with this environment, which is this. I think what you're getting right now is just sort of a correction. Okay, I believe that the longer term secular bull market is still continuing to be higher, and I still continue to think that we are going to see an environment where we're probably only halfway done through this secular bull market. If I look back through the past on this chart right here, I can see you had kind of a seventh inning stretch that happened in the bull market in the 50s. In 1987, you had another seventh inning stretch. And really 2000, believe it or not, is just 7 years in from when this bull market started. We're probably getting another seventh inning stretch. So from my perspective, I think this is a market that you want to still be longer term buying the dips. And we might get a little bit more volatility in the near term, Anthony, but longer term, the trend is still up, and I think there's really no other alternative, and you need to be buying equities.
Good to hear. So another thought, something I wanted to talk to you about was that it seems to me that there's a lot of people that are getting fatigued by all the things that are impacting this year. I mean, there's certainly been quite a few things that have been abnormal, if you will, in 2020. As we move into 2021, do you see the markets and the business putting that behind them and driving back to growth and most certainly a new normal?
I think the key to having more of a normal environment in 2021 and from here is really going to be what happens with COVID from here. I mean, there's lots of discussion that Minnesota may announce as early as today that we may have another round of lockdowns, which means that our kids are going to be working from home again. I haven't told my wife this yet, but kids back at home again for more schooling is certainly going to create a little bit more of a perhaps tense environment around the house as they're trying to keep them focused on the schoolwork. But going forward for 2021, I do see the economy recovering. We just put up over a 33% annualized GDP rate, better than the decline that we had seen in the second quarter. And I think as you progress through the 2021, if we can get a vaccine, you'll start to get this COVID-19 pandemic under control. And I think you'll see the economy pick back up and continue to strengthen, and we'll move forward from here. But also note that gasoline prices have come down quite a bit. That's also a pretty big stimulus. If you look at the industrial production numbers, they are also suggesting an expansion at this point in time. So from a business environment, I definitely think it's going to continue to keep getting stronger. And I think in terms of the sectors of where people should be positioned as you move into 2021, clearly I think the tech stocks are going to continue to lead. I think you're also going to see the consumer cyclical stocks continue to be strong, and then healthcare around the pandemic and medical treatments around that. So those are three areas, Anthony, that we've been recommending investors remain overweight at this point in time. One last thing I would also mention too is there's about $4.8 trillion of cash still sitting on the sidelines. And so while everybody's been very nervous about the market, the returns that you're going to get, I would just make this observation that with $4.8 trillion of cash sitting on the sidelines, almost double where you were at back in 2018, suggests, Anthony, there's a lot of dry powder. A lot of dry powder that people are going to want to put back to work. They're going to come out of money market funds and put this to work. I would also think that corporations at this point in time are going to want to be refreshing some of their technology, and they're going to want to be stepping up and perhaps putting even more redundant systems in place, given the fact that we've gone through this pandemic, and perhaps you'll see some further hardware refreshes from a lot of corporations.
Just one last question. That's all really good to hear. One last question along those lines, and then I'll turn it over to Bill. Do you think that the resurgence in the COVID numbers are going to temper that for a little while, or do you think that people really just want to get moving and we're learning how to deal with it, economically speaking, if you will?
Yeah, I think that right now, the interesting quote that I heard, Anthony, was that people spend more on snacks in the office place than they spend on, corporate security for their networks. So I think as this pandemic continues to linger and carry forward a little bit into 2021, I think you're going to see a step up in spending on IT security. You're going to see more temporary solutions that people have been doing for people that are working at home become more permanent situations in terms of hardware, software, networking, and all those things come into place. I mean, I know for myself, like I put in a wide area network from my house to Piper Sandler in downtown Minneapolis, and now I can walk into my home office and just log right in like I'm at work. I think you're going to see more of those solutions become permanent going forward. So I don't think the spending is going to slow down, and I think spending on additional cloud-related stuff is going to probably pick up too. This is going to become more permanent and provide workers, I think, more flexibility. There's nobody that I know that works on the East Coast that was commuting into New York that says, boy, I'm just anxious to get back onto the subway and take that into the city. Whereas instead, I think there's going to be more of a flexible work environment where you almost have two office settings, one at your house and one that's at home. So again, I think that's going to drive more spending on technology-related items.
Yeah, I certainly agree with you regarding the flexibility, that's for sure.
Hey, Craig, how are you viewing liquidity and companies' access to capital over the next 12 months?
There is absolutely a ton of liquidity in the system out there at this point in time. The Fed has said that they're going to keep rates low until 2023. It's not. There is plenty of liquidity out there. I don't see any inability for corporations to borrow, to do any of those things. You even have PPP money out there that's available if people do want to take advantage of some of that, given the downturn you've seen in some of their businesses. But liquidity to me is ample. And your biggest problem right now, I think, though, is velocity of money, right? There's a ton of money out there, but it's not moving very quickly. So if you think about no velocity of money, you really have a very difficult time of getting any sort of inflation starting to happen. Remember the old equation from our economics class, Bill? M times V equals P times Q? Well,
Yes, I do. I was an econ major.
As an econ minor. And so we just have a problem with V right now. There is no velocity.
Many of our viewers, Craig, are business leaders. What steps should business leaders be considering over the next 12 months between COVID, the election, and just the changing environment as to how they should run their businesses?
Yeah, I think what a lot of business leaders are going to do, and again, we've got great leadership here at Piper Sandler between Chad, between Deb, between the head of IT. What they're providing here for us, I think, is a model example. I think for a lot of people, they're providing a lot of flexibility to the employees. For those employees that feel comfortable to come into work, they're allowing that to happen, given the pandemic concerns. They're even doing things such as bringing in lunch and things like that so they can get some of that collaboration back together. But again, lunch socially distanced, okay? They're also looking at using tagging solutions where you'll wear an RFID device that will basically say, are you getting too close to the person next to you? It'll also track what floors you are at in the building so that if there is a COVID breakout that was to occur or somebody did turn positive, they could very quickly look at the logs and say, hey, these employees were on this floor. We better notify them via email that there was a COVID test that came back positive, and then perhaps they should go get themselves screened also. I think also that compassion, I think, is another thing that I think leaders need to be thinking about. These are difficult, challenging times. Bill, as you know, with our kids at home and trying to learn from home, we're trying to work, our wives are trying to work, spouse is trying to work. It's a challenging time. So I think a lot of compassion for business leaders to their employees, I think, is an important thing. I think that'll build up a lot of loyalty with their employees too. So those are a couple things that I think we need to be focusing on. And again, flexibility to work where you want, when you want, how you want, I think is going to be one of those mantras going forward that, again, for those people that would take a lot of public transportation, I think is what we're going to need to have is more flexibility.
I think you're spot on with that, Craig. I mean, even in our own organization too, I mean, that's been key. I mean, fortunately, we were able to move to a remote work environment pretty quickly, and that was really considered more of a temporary measure, but it seems like a lot of components of that's going to be a much more permanent measure, if you will, and flexibility for our teams is critical, especially when they have all the other responsibilities, right? Teaching their kids now at home, they take a much more active role in that. So yeah, it's really, organizationally, it's how do we accommodate all the new needs that everybody has, right? And continue to make business flow. So that's really, really important. It's interesting that the election went in a different way than a lot of the pollsters and the media were expecting it to go. And I found myself personally that it was very interesting. Even though we haven't picked a president yet, it went very differently than everybody was saying. You see any messages coming out of that to the business community? What do you think that's telling the business community today?
First off, I would agree with you that this election hasn't gone exactly how I would have thought it would have gone. In fact, I do owe a few people dinner that might be here on this web call here today. But one of the things that I had observed is there was an old market model that we've looked at, which would be And again, the president isn't totally confirmed and it isn't finalized as of yet, but we've looked at an old market model that has said since 1900 that if your incumbent, if the Dow is higher 3 months into an election window or an election period, there's an 80% probability that your incumbent president, Democrat or Republican, is ultimately reelected. So that model would be inconsistent with history if Joe Biden is elected in here. And again, that was an 80% probability. So that was an inconsistency. Also, in terms of the media, I think the media, frankly, needs a little bit of a reboot. We really need to know the facts, is what people in this country need to know. And I appreciate that everybody's got an opinion. They're sharing those opinions. But I think the media needs to come back and bring us facts, because they missed this particular election pretty badly, kind of like they missed it in 2016. And we basically had saw coming into this election that, you know, Biden was going to be ahead by 7 points in a lot of these popular polls that were out there. The election is basically a dead heat in many different states. And now we're going through a process of trying to recount ballots in certain areas. So that's kind of been one of those inconsistencies. There was a discussion that there was going to be a blue wave, and that hasn't also happened. The Senate also did not turn over. So I think there needs to be the use of more technology and the use of different polling methodologies going forward from here to really understand what people are thinking. And as an example, if somebody was to call me asking for my opinion on an up and coming election, I wouldn't give it to them. Okay, so we can't just continue to utilize a phone call-in service to look at what these elections are. There's other folks that are now starting to use email and blended types of media to go forward to figure out this poll data, but there needs to be a full reboot of the polling business. They need to incorporate new forms of technology that they haven't done thus far. So those are some of the surprising things that have come out of this. And I think some of the changes, Anthony, that I'd also add in here that need to come out of this next, media polls election going forward from here.
Excellent. I agree with you. On the, given all the stimulus that the government has provided in the last 6 months, what do you think the long-term effect of that is going to be, in the markets and in business? I think that's something that a lot of people are concerned with. It's a tremendous number of dollars, and there's going to be even more potentially moving forward. So, and I think it's, it's great that we've been able to keep the economy moving in that way. But what are we going to be paying for later on?
Well, that's a great question. And when you bring up this question, I like to go back to my favorite site here, which is usdebtclot.org. And you can see that the U.S. national debt is about $27 trillion. You're at about 128% of U.S. federal debt to GDP at this point in time. And if you put us into the comparison of the rest of the world, you'll quickly see that the U.S. is now the fourth highest debt to GDP around the world. You've got number one is Japan at about 227% to GDP. You go through and you can see Italy at about 157%. You've got Greece in here at about 212. And then you've got the US that's going to be moving higher from here. So from the perspective of what does all this debt mean, I would think that what we're going to see going forward from here is we're going to see, I think, an environment where there's maybe another $3 trillion of debt that starts to come onto this, and we're going to ultimately have to figure out a way to try to pay some of that back. But to be clear, I don't think all of it will need to be paid back. We got to talk about this in terms of nominal versus real dollars. And if the Fed can achieve an above 2% sort of inflation rate in this country, it'll be cheaper to pay it back with a little bit of inflation. But the Fed has been unable to sort of pay to hit that achievable goal, hence why they've come out and they've said, hey, we're going to keep rates low to 2023, and we're going to sort of move above that inflationary target. I suspect that'll be a message that we're going to hear later today from the Fed, is that we're going to let that inflation sort of run hot. Consequences of all this debt, though, taxes are probably going to have to go up. And so if you start looking through taxes, that is certainly not going to help overall market returns if we're going to start to see the personal and the corporate tax rates go higher. In fact, our team has put together here at Piper Sandler, we put together a quick historical perspective on taxes going all the way back to the 1900s. And what we have seen is that from a corporate tax rate, when we've seen it go up, we've seen returns, again, using the Dow only because we need to go back to the 1900s and the S&P 500 didn't exist. We actually saw sort of an underperformance of the market, 3.70% average return in those years following a tax increase, with about a 64% probability rate of being positive. And then if you looked at it from an income tax perspective, it was only a 4.2% return compared to with a 66% probability rate of being positive. So those are sort of below median type return years post a tax increase. I don't think you're going to get that sort of tax increase in 2021. I think it'll probably be an issue in 2022. We also looked at, Anthony, from the perspective of capital gains taxes too. Now, there wasn't as much of an impact. In fact, you had an above average year with a capital tax gain increase. You were a positive 8.17% historically. So less of an impact. Market was higher, almost 86% of the time. So thinking about the environment, taxes, and those things going forward from here, paying back all this debt, look for tax increases probably announced in 2021, but probably not effective until 2022 would be my guess. And I think we will eventually work that down. But again, it won't be as big of an issue thinking about it from real versus nominal dollars perspective.
Interesting.
And Craig, to follow on what you said before, you believe interest rates will remain low for some period of time.
Correct. I do believe that will be the case. And as I think about the long term, this is one of my favorite charts. So I got to put it up for Bill. You're econ major in here. I got to put this up for you. But this is a long-term chart of 10-year bond yields going back all the way to the 1940s. So I love to pride myself on having all this sort of old, kind of rare historic data to think about markets to frame out the perspective of where we think things are going to go. But I mean, we're literally at the lowest 10-year bond yield this country has ever seen, going all the way back throughout time. And we're at the lower end of this chart. I think ultimately from here, Bill, that rates are going to stay low at the short end of the curve, right? But if we're going to continue to keep borrowing money for the pandemic response, I think we've got a challenge that we're going to have to face. We're going to anchor the short end of the curve, but we keep borrowing money. What do we think the bond market's response is going to be, right? 10-year bond yields probably got to move up. The curve has probably got to steepen. So if I take a zoomed in chart of this long-term bond chart I put up, I think that the key number that everybody needs to be watching in the business world is going to be 90 to 95 basis points on the 10-year bond yield, okay? As we start moving above that 90, 95 basis point range, we're going to start reversing a downtrend in rates we haven't seen since 2018. So anybody in the business world that wants to buy new equipment, lease new equipment, make capital investments, or any of those things, they're going to be borrowing some funds to do that. Now is the time to lock in at some of these extremely low rates, as this isn't going to be around forever. Just like I say to people that are wanting to get it out of these apartments in these cities, move out to the burbs, have more space. We may have more COVID-19 things like that in the future, and that's not meant to scare you. But if you are, and you got this sort of split working environment, you've got more space. So I think being cramped in smaller apartments and these kind of things and bringing it all the way back to rates, now is the time for people to take action and be thinking about capital improvements, changes, anywhere they need to borrow money, borrow that money and lock those rates in now and watch that real inflation come, as the Fed is going to be talking about, and sort of inflate away the pain. But 90, 95 basis points is really what we got to be watching very carefully.
Interesting.
My view was that we were going to see, by the way, somewhere between 1 and a 1 1/4 10-year bond yield by year end. That alone is going to start to lead to a bit of an investment shift among a lot of portfolio managers. It's going to start taking some money out of those FANG stocks, where everybody's been making the argument that low rates means higher PE multiples going forward for an extended period, and will probably start to lead to a shift to a little bit more of the value or growth parts of the market. And as that happens, you'll see some of the financials and some of the other companies start to pick up in terms of performance. Great question.
Great response too. It's very interesting. We're seeing a lot open up in the market today. Within the mid marketplace where we tend to focus our efforts. So we're seeing some of the projects that were originally put on hold early in the pandemic, earlier in the year, now starting to shake free, and customers are looking, I think, to get back into the market, start investing in their businesses, and get back to growth. So I think that falls right in line with what you're saying. Good. Well, thank you. I know we have some questions and answers. Do we have any questions, Kelly?
Yes, we have one question, but I do just want to invite anyone that's on the line. If you have any questions, just push them in through the Q&A box and we'll certainly try to get them answered. The first question that came in was thoughts on another relief bill being passed in 2020.
Great question. So McConnell has said that regardless of who is president, Trump or Biden, that they do want to move ahead with another relief bill here in 2020. So I think that's a yes. They're going to get something done, and the market has really been keying off of more and more stimulus. So the answer in short is yes. The question for me though is, what's the magnitude? It's not a question of if, it's what's the magnitude of the fiscal stimulus they're going to put through. I think if it's $1 trillion, it's going to be taken as disappointing to the market. I think if it's taken as $6 trillion, it's going to be taken as way disappointing to the market, that the problems of the pandemic are far worse than we realize. So I think the sweet spot for this is going to be somewhere between maybe $2 to $3 trillion in stimulus. And I suspect, again, yes, that could probably get done between now and year end. And I don't see Trump as a obstructionist to do that. He's here to help people. I don't think he's going to try to slow that down or obstruct it at all. Nor will the Senate. Great question.
That was a good question. The next one we had come in, do you see a labor market recovery in 2021?
I do see the unemployment rate continuing to work its way lower. I know that as you start breaking apart, U6, meaning people that have quit looking for work and stuff like that, you see the labor rate go down a little bit for that, and a little bit for people just simply saying, I give up, I retire too. But yes, I do see this pickup in the labor rate coming up. There's still, about 11 and change million people that are still unemployed. A lot of those are in the service industry. So it will pick up, but it's probably going to be a little bit more back-end loaded if you think about, or mid-year loaded for 2021, because I think we got to get through this next wave of this COVID, and then you'll start to see jobs at hotels, restaurants, cruise lines, airlines, and those things start to pick back up again as that starts to get tampered down. That's also going to happen in conjunction with a vaccine coming in, assuming that some part of the population would be willing to take a vaccine. Not everybody will be willing to take a vaccine, and I don't think the government's going to force anybody to take a vaccine. But I do think that labor market will pick up, but again, more year-end loaded versus right away early in January, say 2021.
While we wait to see if any more questions come in, any final thoughts from you guys? Anthony, Craig, Bill?
I'll grab that question. I would say this. As I think about markets from here, and I think about business investing from here, I really do think now is the time for not only individuals to be thinking about adding, looking at this market continuing to move higher. We're looking for 3,600 on the S&P by year end. Interest rates are at extremely low levels. So now would be the time for people to be making investments, not only individuals into homes or other sort of assets like that, but corporations that are looking to be, deploying capital and enhancing their infrastructure, whether that's computer equipment, whether that's phone systems, whether that's, some of their property or other things. So I think now is the time for people to take action and start to, not be as scared of COVID and trying to go into the shutdown mode, but use this sort of downturn as an opportunity to pick up market share. That's what successful companies like Intel have done over years. They sort of counter-invested where they could in their semiconductor manufacturing process. And when they came back out the other side, because COVID will not be here forever. And when you come out the other side, you'll be in a better position and better able to pick up that market share.
I agree, and it's a great time to reinvent many businesses today, and I don't think there's any business that hasn't been really challenged with everything that we're going through and have gone through this year. And taking the time to reinvent the business, create the new normal, and drive back to back to growth and back to some level of normalcy, knowing that it's going to be different, I think is critically important. I know that our focus has been just that. Right? How are we going to be different? And the other thing we focus on is how do we help our customers, right, figure out how to be different and how to drive towards that new normal. So there's a silver lining to every cloud, and this is a great opportunity to get on the good end of the backside of this.
Yeah, to follow on what you said, Anthony, that's a great point. It seems like when the shutdown happened in March, that businesses were just trying to figure out how to work from home, how to continue to operate in the new environment. And now we have seen more of a shift to, now we've been able to function with people working from home. How do we grow our businesses? How do we evolve to become the kind of business we need to become? I was talking to a CEO of a public company earlier this week who said they went to a fully digital model. And this was something they were going to do anyway, but the shutdown accelerated that process where technology, which was technology projects usually are, it's going to happen, it's going to happen, it's going to happen, to shut down, everything had to happen, and it accelerated that process. So we've seen in our business more of a desire for, let's figure this next thing out in technology as to how do we evolve our business model, because the old way doesn't work anymore. We got employees all over, we have clients and customers with different types of needs, and we need to survive and grow our businesses in the new environment, which is in many ways permanently structurally changed.
Absolutely. Well, that was good. Craig, thank you so much for your amazing insights. We really appreciate it, and hope we get to do this again sometime with you.
Yeah, I'd love to anytime. And anybody that would like to get a copy of our slide deck, Kelly, you could shoot that around to anybody that would like to get a copy of that. And again, Bill, Anthony, Kelly, thank you very much for having me on today.
Of
Craig,
course,
thank you.
a great discussion today. Thank you so much to Craig and Piper Sandler for their participation today, as well as Anthony from MicroStrategies and Bill from Vantage Financial. We hope you all have a great rest of your day. Bye.
Thank you. Bye-bye.
Thank you. Thank you, everyone.